R. Calculate and interpret the market/book ratio and the price/earnings PE ratio. The market/book M/B ratio compares the market value of equity to its book value. It is calculated as market price per share divided by book value per share. A ratio greater than 1.0 suggests investors expect future growth, strong profitability, or valuable intangible assets not reflected on the balance sheet. A ratio below 1.0 may indicate undervaluation or poor expected performance. The price/earnings PE ratio measures how much investors are willing to pay per dollar of earnings. It is calculated as market price per share divided by earnings per share EPS. A high PE suggests growth expectations, while a low PE may signal risk, limited growth prospects, or undervaluation. Interpretation requires context. Industry norms, economic conditions, and earning stability significantly affect both ratios. Trend analysis over time enhances insight into market perception and valuation changes. S. Calculate and interpret book value per share. Book value per share represents the accounting value of equity attributable to each common share. It is calculated as total shareholders' equity minus preferred equity divided by number of common shares outstanding. This measure reflects the net asset value recorded on the balance sheet. Book value per share provides a baseline measure of equity protection. It indicates the theoretical amount shareholders would receive per share if assets were liquidated at book values and liabilities settled. Comparison with market price reveals valuation insights. If market price significantly exceeds book value, investors expect strong future earnings or growth. However, book value is based on historical costs and may not reflect fair market values. This measure is particularly relevant in asset-intensive industries. It offers greater insight where tangible assets represent a significant portion of company value. T. Identify and explain the limitations of book value per share. Book value is based on historical accounting measurements rather than current market values. Assets such as property and equipment may be significantly undervalued relative to their economic worth, while intangible assets like brand reputation may not appear on the balance sheet. It does not reflect earning power or growth potential. A company with strong future prospects may trade well above book value, making book value less meaningful for high-growth firms. Accounting policies affect comparability. Differences in depreciation methods, inventory valuation, and asset impairment practices can distort book value comparisons across companies. It assumes liquidation at book amounts, which is unrealistic. Actual realizable values may differ significantly, limiting usefulness for valuation without supplemental analysis. U. Calculate and interpret basic and diluted EPS. Basic earnings per share, EPS, measures profit attributable to each common share. It is calculated as net income minus preferred dividends divided by weighted average common shares outstanding. Basic EPS reflects current ownership structure and profitability per share. Diluted EPS accounts for potential share dilution. It incorporates convertible securities, stock options, and warrants that could increase shares outstanding. Diluted EPS is calculated using the treasury stock method or, if converted method were applicable, diluted EPS provides a conservative profitability measure. It reflects the potential reduction in earnings per share if all dilutive securities are exercised, giving investors a more comprehensive view of ownership impact. Comparing basic and diluted EPS highlights dilution risk. A significant gap suggests substantial potential shareholder dilution from convertible instruments. 5. Calculate and interpret earnings yield, dividend payout ratio, and shareholder return. Earnings yield represents the inverse of the PE ratio. It is calculated as EPS divided by market price per share. It shows the percentage return in earnings relative to stock price and allows comparison with alternative investments such as bonds. Dividend yield measures cash return relative to market price. It is calculated as annual dividends per share divided by market price per share. Higher yields may attract income-focused investors, but could also indicate limited growth prospects. Dividend payout ratio measures the proportion of earnings distributed as dividends. It is calculated as dividends per share divided by EPS. A high ratio suggests income distribution focus, while a low ratio indicates reinvestment for growth. Total shareholder return combines dividends and capital appreciation. It reflects overall investor return and is calculated as price change plus dividends divided by beginning price, providing a comprehensive measure of investment performance. W. Identify the limitations of ratio analysis. Ratio analysis relies on historical financial statements, which may not reflect current economic conditions or future performance. Since financial statements are prepared using past data, ratios may lag behind real-time operational or market changes, limiting predictive accuracy. Accounting policies affect comparability across companies. Differences in depreciation methods, inventory valuation, FIFO versus weighted average, revenue recognition, and estimates can distort ratios, making cross-company comparisons less reliable without adjustments. Ratios do not capture qualitative factors. Management quality, competitive positioning, technological innovation, regulatory risks, and brand strength significantly affect performance, but are not reflected in numerical ratios. Seasonality and window dressing can distort ratios. Companies may temporarily adjust working capital or timing of transactions near reporting dates, causing misleading liquidity or profitability measures. Ratios must be interpreted in context. Industry norms, company strategy, life cycle stage, and economic environment all influence what constitutes a good or bad ratio. X. Demonstrate familiarity with sources of financial information and industry ratio averages. Primary financial information for public companies comes from audited financial statements and regulatory filings. In the United States, these include Form 10-K Annual Report, Form 10-Q Quarterly Report, and other filings submitted to the SEC. These reports provide detailed financial statements, notes, and management discussion and analysis (MD&A). Company annual reports and investor presentations provide strategic context. They supplement formal filings with management commentary, performance highlights, and future outlook. Industry ratio averages are available through financial databases and industry associations. Sources such as Bloomberg, S&P Capital IQ, Value Line, and trade publications provide benchmarking data. Analysts must assess reliability and consistency of sources. Understanding data origin, adjustments, and methodology is essential for accurate comparative analysis. Why? Evaluate the financial strength and performance of an entity based on multiple ratios. Comprehensive evaluation requires integrating liquidity, leverage, activity, profitability, and market ratios. No single ratio provides a complete picture. For example, strong profitability combined with weak liquidity may signal short-term financial strain. Trend analysis enhances evaluation. Comparing ratios over multiple periods reveals performance direction, stability, and sustainability rather than relying on one-year snapshots. Cross-sectional benchmarking strengthens conclusions. Comparing company ratios to industry averages and key competitors helps determine relative performance and competitive positioning. Ratio interrelationships provide deeper insight. For example, ROE can be decomposed into profitability, asset efficiency, and leverage components. DuPont analysis, revealing drivers of performance. Effective evaluation translates analysis into decision-making. Managers and analysts use integrated ratio analysis to assess creditworthiness, investment attractiveness, operational efficiency, and long-term financial stability.